Will says, I've been using the radioactive trading method to roll long calls and puts. All right, just wondering if I'm doing it wrong. I'm buying a couple of strikes OTM initially. Well, we've already sort of covered that in relation to the married put. I'm sorry, 1 or 2 strikes out of the money when the price is at the money. However, I've rolled multiple times. It appears since I am rolling when the delta is about 0.5, I am only getting at most 50% of the potential return. Oh, okay. Okay, I see what you're saying. Do you think I should have done another... Sorry about that. It's not opening wide enough here, so I'm scrolling as I'm reading. Do you think I should have done either A, roll the option to a smaller delta and wait for the price to reach that strike, or wait until the option gains a higher delta and then do the roll? Just wondering. So you say roll long calls and long puts. So now I'm confused here. You might have to clarify this for me, Will, and before I answer your question, I might wait for your answer and then move on to JB's, as I promised, related to that short call. You're saying to roll long calls and puts. Now, are you referring to the fact that you're not really in a married put position? Okay, that you're doing a simulation where instead of buying XL and X as we were looking at 120.30 and buying a December 125 put, you're saying, well, I don't want to buy the stock. Let me buy an in the money. You said out of the money, though. Let me buy an out of the money 130 call and an out of the money 110 put to create a strangle. That you don't actually own the stock. You're creating a short strangle. And you're having problems now that when it gets to the 130 call, you're going to roll it to try to take advantage. And if it drops down to 110 put, you're going to roll that to take advantage. I think that's what you're saying, but I'm not clear. In which case, you can't really treat this like a radioactive trade. It's not the same structure. You can see it here. The problem with an in the money or even out of the money short strangle, you're an out of the money. I bought the 130 call and I bought the 110 put. Okay? The problem with this position right here is you're not delta neutral, you're delta opposed. What does that mean? That means if the stock moves up a standard number in the first 30 days, 3%, 4%, or 5%, the delta you gain on the call is going to be equal to the delta you lose on the put. Benefit of the married put is what? Yes, I buy a put option that maybe has a 0.55 to 0.65 delta, 1 or 2 strikes in the money to give me that controlled risk. But the stock has a delta of 1. So even if the stock moves up $1 the first day, I'm already profiting 45, 50 cents on the position. This is counter. If the stock moves up $1, maybe even $2 in the first week, what you gain on the call, you're going to lose immediately on the put. It's delta opposed. So you'd mentioned, oh, when this delta gets to 0.5, it gets to at the money, I'm going to roll it. Well, you've probably lost 60% of that delta that you saw gain on the put on the call. So what's really giving you an advantage here? Rolling the put at that time, or if the stock moves up and you decide to roll the put up in that case, you're just swapping delta from the call to the put until it really moves enough where it's countered the delta of one or the other. Very rarely will you see the call delta go to 1. It might go to 0.95. It might go to 0.97 if the stock really took off, and let's say you're rolling your put in that fashion. But then eventually, you got to do something with this. You got to take the profit off of this to lower the cost basis here, because all you're doing when you're rolling is increasing your cost basis and widening this strangle. Okay? So if that's what you're doing, it is very risky to try to treat an in the money or out of the money long strangle with the similar way as you do a married put, because you don't have the positive delta at the start. I have a bullish trade with the married put that looks, yes, like a standard out of the money long call. You could compare it to that. But buying a call and then trying to buy a put option, I'm buying a call instead of buying the married put because I like the risk graph, but then adding a put for protection, this is a different strategy because you're delta opposed at the start. You don't have a positive delta to the upside, which means you don't really have as much negative delta to the downside, but the movement in this area is no gain or no loss on delta or on premium because you're delta opposed. That's the issue with trying to treat an out of the money or in the money strangle for that. Okay, so I'll wait to see your response in that situation. Okay. Okay, so Will said yes, not a married put, just calls or puts by itself. And this is the problem you're running into, is that it won't, okay, so just, I'm sorry, okay, so just long calls. All right, so you're just doing the long calls, okay. I'm going to tell you a secret. I hope it's working out well for you. I guess the last couple of months has been a little stagnant, but there has been good rises. We saw with Tesla and other stocks as well. So if I had bought the stock and bought the 130 put, I'd have a risk of about 743, which is equal to the cost of buying the out-of-the-money 130 call on XLNX. This is what Will says he's doing, okay? You're starting off with a delta of probably about, maybe 0.4 or maybe 4.5, equal to the positive delta I have on my married put with a stock delta of 1 and a call delta of 0.65 or so. Okay, or maybe 0.6. In any case, one of the tricks, and if you scour through YouTube, you can hear me mention this, is that I never, if I was in this position, if this was my married put, but I was long the stock and had bought the 130 December put, and you just bought the 130 call, I likely wouldn't roll this position. I wouldn't move the put up until the stock was trading maybe at 132 or 133, between the two strike prices, not when it hits it and the delta's at 0.5. For me, why? Because as the stock moves up to 133 or 134, what's happened? My delta on my put has dropped to negative 0.5, goes up another point, it's at 130, goes up another point, now my delta is negative 0.4. So I'm gaining 60 cents, and then maybe it even drops to negative 0.35. So I'm gaining 65 cents. Your call delta is going up as well, but you see what I'm talking about there? You might want to wait for the delta to get up to 0.6 or 0.65 before you roll it, because 0.5 might not be giving you the advantage you want. That's all I'm going to tell you about that in relation to what we call income method number 4, rolling the put. I think it's better to let it go above the put strike price, in your case be above the call strike price, to get more advantage of the upward movement, maybe between the strikes, and then look to go up to the 135. And if it suddenly spiked up to 136, hey, I might just roll to the 140. All right? I think that might give you a better delta edge than what you've been experiencing by rolling it right when it hits to 0.5. Not to say that it might continue up and go higher and you'd get a lower delta in those scenarios, Will, but that's what I would look for. Quick comment on married put since we're here. This is a long call, but let's say this was the stock and the put. Paul just quickly asked, in selecting months, do you consider differences in implied volatilities? Nope, I do not in the married put combination, Paul. Do you know why? Because my focus is on the risk itself. If it came up in the search, I think we've shown this before, but if it came up in the married put search on the criteria that we use for the radioactive default screen, there's different months, December's and January's, of course, because I want it to be 150, and there's even a March in here as well. Okay? Oh, this is that Tesla search. I'm sorry. Let's go to the main search. Okay, but here's the consideration. This might actually be a better example. Look at the implied volatility. This is all for Tesla, but look at the implied volatilities here. They're all pretty much the same. What's my focus? It's here. It's on the risk. It's not on the implied volatility. Okay? It might be on the percent implied volatility range. That's a different topic, because I don't want to buy something that's maybe on its higher implied volatility range and risk it collapsing. If it's about 80% of its IV range, I probably would look for it to be 50%, 60% or lower. But they're all the same here. They're all within a reasonable bounds in this case where it doesn't matter on the same side. Oh, there's a subtle difference between the December 275 with an implied volatility of 0.4893, the January 275, 0.4914. The January 280 is at 0.48, and the March 280 is at 0.50. That's nothing to me. That is negligible, wouldn't affect either trade. My focus is on the risk and on my expectations of where I think the stock's going to be trading in the next 20 to 30 days. and expectation of what I expect to gain in the next 2 to 3 months. I only consider implied volatility as a scenario if I'm doing a diagonal spread where I'm selling a call immediately against it on a leveraged position, and if I'm looking at, say, buying in October versus a September or a December versus what I'm already planning on selling for a July 26 expiration call as a diagonal spread, then I might consider it because volatility really impacts that diagonal spread position. Doesn't impact the Mary put that much. I had mentioned the straight search. Okay, I've got options again. We've got December's, we've got January's, I've got February's, I've got 15 different stocks on this first page, everything from $70 stocks to $30 stocks to $170 stocks that match our default criteria for the radioactive screen. The implied volatilities. The highest one is 0.43, lowest one I think is 0.29. They're all within a range because of the criteria that's always set. I don't need to filter by implied volatility. The risk, time frame, and the stocks I'm looking for are already filtering that without even screening for implied volatility. My focus is on the risk and the performance of the stock and my expectation going forward. Okay, it's the best way I can answer that. All right. Going back to that in the money covered call, Binh says I can use the profit of the short call gain and buy extra shares at a low. Okay, sure, but if the stock falls, then you're losing on the shares you just bought, even though they're kind of paid for from the premium, and you're losing on the covered call if you have that large decline. Don't have a guaranteed profit, put in a stop order, but what do you know about a stop order, Binh? It's assumed insurance. I get what you're doing. You're selling an in the money covered call in your 200 or 300 shares after the stock has been depressed to sort of help hedge the loss and give you further downside. Now you're taking that premium that's hedging the downside and buying more shares. So if it moves up, you're attempting to double dip in a sense. I get it. But you're taking the premium that was being used as the hedge to put back in the stock, and if the stock continues to fall down, that could be an issue on those shares. And the shares you own, the 100 shares you own. Okay. All right. Let's see here. Daryl. I'm sorry here. Oh, okay. So yeah, Will, that's the answer to your question. Okay, we reviewed your question there and talking about the delta. I'd let it go a little bit lower than 0.5. I usually roll my puts when the stock is trading above the put strike price. So here, if I just open Team at 138 and I bought the December 145, if the stock hit 144, 144.50 in the next 2 weeks, I wouldn't roll it. If it hit 145, 145.10, I'm probably not rolling it. If it goes up to 146, 146.50, or 147, I'm looking at the 147.50 strike if it's there, or the 150, and that's when I'm rolling. When this delta is probably at a negative 0.4, and your delta would be equal to maybe 0.6 on the call. That's when I would look to roll it to get the best advantage, in my opinion. Daryl asked a quick question. If I take the trial, what version of the program is provided? I think right now we are actually offering the real-time service, not the premium, which gives you the historical. I think it's the real-time service during that trial. Do you select the version, the cost that you want? No, we just give everyone on the 14-day free trial the real-time service, which would be about $120 per month, I believe, right now. So you'd have the real-time service during the trial. All right, back to the portfolio. He's been patient. We're at 525. JB, this is a tough one. Switching gears completely now, off of protected positions, off of positions that have a known risk to the downside and unlimited upside profit potential with a married put or a long call, and a capped gain with a covered call. What JB did is he's been rolling calls on Tesla, naked calls on Tesla. He's also got some naked puts here that are profitable, but he's been rolling naked calls on Tesla. When the stock fell, he realized that he should have bought back this November 190 call that he sold for about, after rolling, was a cost basis of $24.90. But then the stock recovered quickly. Is now trading at $245.08, 50 points above the strike price. The buyback cost is around $55. The loss right now in this position is about $3,900, if I'm not mistaken. Now let's go back to the portfolio here. We sold it for $24.90. I'm sorry, it's at 65.58. So the loss right now is $4,068 if liquidated. So JB's question is, what can be done to hedge this position? Unfortunately, it's extraordinarily difficult at this time. Earnings, by the way, is coming up on July 24th, so something has to be done with this position soon. You take a huge gamble. If you leave this open and you think Tesla's going to fall from the earnings, it might. I don't know. But that's a huge gamble, because if it goes up to 290, now you're 100 points in the money on this thing. Right? It's going to be a $65 loss. Okay, so is there any magic that can do anything? At this point, not really. You'd say, okay, well, we know that the earnings are coming out July 24th, so let me go cheap to August 2nd, and let me try to buy a couple of cheap calls that are not that cheap, but cheap out-of-the-money calls. What would that do? Well, it would help hedge further loss if it moves up, and if it really shoots up, I can gain on the call position. But you have to buy two. And this one that you're buying isn't hedging this, it's just stopping the bleeding above 255, which you can see is a $65 loss where you're at right now. Okay? But what happens to this position? Yeah, now I have infinite upside. My upper break even, though, is not going to be till 315, 320, somewhere in that range. And if it starts to fall, you're still at a loss because you're losing on the added value, $1,700 into the position. Max risk goes up to 64.93 if the stock, Tesla, is trading right at 64.93. This isn't on November expiration. This is on August expiration. So if it just moves up a little bit to 255, you're double the loss you have right now almost. Now, you're 4,000 right now, so it's an increase of 2,400. But if the stock keeps going up, well, you've hedged the loss here. You're only losing 1,000 at 300, 2,000 at 295. Still not a gain. Could you roll this call up? I looked at a couple of examples, and the answer is no. I didn't see anything really suitable. So we're in November. Buy back our 190 call at 65. Okay, start over from scratch. Well, it's not even considered a roll. Where are we at? Well, as we mentioned, we're at a loss of 4,000. That's our starting point. We're starting $4,000 in the hole. Is there a strategy that could give us a $4,000 profit without increasing the risk? No. Anything that we do now is going to add potentially more risk than the risk you're already taking. If you just roll a naked call and you go to higher strike prices, in order to get $40, $41 back, where do we have to go? Nothing out of the money. And we don't want to be in the money anymore, do we? There's nothing out of the money here. You might be going out, I think it was June I saw. I apologize. Yeah, it's June. So I go out to the 260 for June. You're crossing three more earnings dates. I'm sorry, one. Yeah, 3 more earnings dates. It's almost a year out from now. Okay? And it gives you a credit of 124. So as long as in June the stock's below 260, you're doing all right. It's so dangerous, though. And where's the other problem with this? Yes, you sold this call for $41.93 to hedge the loss. Okay, let's clear this up. What does this really look like? In essence, I'm really selling a June 260 call for 124 for a 0.5% profit, 11 months out in time if the stock stays below that strike. This is really difficult because the scenario here is A, we don't know what's going to happen. B, you're holding it for 11 months for the hope of a 0.5% profitable return if the stock's below 260. And it's not a loss. I will give it that. Absolutely true. But again, you say, oh, well, I just have to make 124. No, no, no. The price at this option is $41. Okay? The 124 is if that option goes to zero. You're not going to see that last $40 worth of time decay until you get within the last 3 to 4 months, still 5, 6 months away from now. So that's a repair. That's a potential roll, but it's very, very difficult. And you say, oh, well, can I buy a call now on this at a different strike and convert it to a spread or something else? Well, you could, but remember, this really only gave you 124. Any option you buy on Tesla is going to be, any in-the-money call to create a bull call debit spread is going to be $30, $40, $20, right? That debit's not going to work. It's going to be a bull call debit at a loss. You buy a bear call, it's going to be $10, $8, $9 going out of the money. You're doing a bear call credit at a debit, okay? So that's what we're kind of looking at here. I tried, let's put your call back in. I tried other, let me just do it from the portfolio again, JB. From when you sent your email to be working on other things and analyzing this position, I tried other scenarios, creating near-term sort of broken wing butterflies, far-term broken wing butterflies to get something that looked reasonable, and I honestly, I just can't. I could not find anything in that scenario that looked like a good repair. Okay, I tried. Doing a ratio spread of some kind really won't do that as well. Okay, it's a little bit different. What was one thing I tried? So we're at the November 190. Sold call already, which is now very deep in the money. That's the problem. Without adjusting it, you know, you could do something obscure. I believe it was a 195, 180. No, definitely was not that. I'm sorry. It was higher. It's a 220, 170. Oh, yeah, it was ridiculous. Okay, so my thought was, well, if we do a wide bull put spread, we could get a $12 premium to help hedge the loss. Okay, you pay $24.90 here. We're paying this amount here. We're getting this premium in, and then we got to pay $6.75. So you've got this sort of confusing thing that doesn't satisfy the need of protecting the upside, but we've got a $6.85 credit if the stock's down here in the 220 range, which is not too far. Okay. So to hedge the upside, is there a call that I can buy in November that's less than $5? And the answer is no. Until I get up to the 340 range, I think it was. Okay, so what am I doing? I'm doing a very obscure leg into a long iron condor where the price is now. You're at less of a loss, only 27.05 from the 4,000 you're at because of still taking in a credit here, 1870 plus 400, so you're paying about 1,000 in and you're keeping 1870. So you can make a profit of 295 if the stock's between 222 and 187. Okay? You take a max loss of 1,040 if it falls all the way back down to 170, which you'd have a profit on. But it doesn't do that extra case of leaving it to the upside with earnings coming up. So you say, okay, maybe I can buy two, but you can't now. All right, this would leave the upside open if you bought two of those deep out of the money calls, but now there's no profit here if it falls back down. It's a guaranteed loss. She's everywhere from probably 410 to 0. Not constructive. Less of a loss here, a little bit less of a loss here, but that extra profit doesn't kick in until you go up there and you still have a loss. That's the problem. If it takes off at earnings, tripling the loss you have now. That's kind of the tough scenario to go with. Okay. So I tried different things. Okay, someone says, can he short the stock? Now what this would do is create a covered, why did I do that? This would create a covered put position. Instead of a covered call where you buy stock, no, I'm sorry, you don't want to do that. You can't create a covered call now because you only collected $24 and the stock's above the price. There's a covered call. It says, can he create a covered put? Well, no, because you were so short the call. That's what it was. You can't do the reverse. And if you sell the stock here at 245, what you're doing is trying to double dip on a double bearish position, and it keeps about, did that do one share? Oh, come on. Long story short, it's not worth it. You create sort of a double bearish position, which still gives you a huge loss to the upside, a larger maximum risk at every level, but if it falls back down, you could see more profit. That's not the solution. Buying the stock now is not the solution to create a covered call because the stock has moved more than the $24 above your price. All this would do is give you a guaranteed loss on the bear call or covered call of $3,000. Close to where you are now, but it stops the bleeding to the upside. Can you just buy an out-of-the-money call, which we looked at first? Well, yes, but then that doesn't help. It stops further losses at earnings, but you're still locking yourself in to close to the loss where you are now. Okay, so this is a really tough one, JB. I'm going to ask Ernie, of course, if he has any thoughts on it, but that's the best I struggled with. I tried looking at those odd repairs, broken wing butterflies, ratio spreads on top of this to create sort of a condor, rolling the call itself, and you saw how that turned out. I don't want to see you take a loss, but at the same time, with earnings coming up and not knowing where it's going, I don't want to see you take a higher risk. I don't want to see you take a higher loss, which is potential if you do nothing naturally, and it goes up to 300, 290, somewhere in that range. You know the loss potential there. Buying any call now might stop further losses at a certain point, but it's not going to get you to profit if it takes off, and it's doubtful. You're essentially legging into a bear call spread. And the only way the bear call spread would be profitable in this scenario is if it does fall just right back to where you need it to anyway. Break evens at 194. Okay, but you could still lose 7,000 to the upside because of the additional cost. You only have 427 in premium now, and this is a 75 strike difference. So you could still lose $7,000, almost double what you have now if you just liquidate it. That's the tough call. Okay, so I'm going to go back to the portfolio. I'm going to change portfolios, and we're going to go to, I don't know if I want Married Put Compare or RadioActive. Let's just see. Haven't updated this in a while, so we're going to have to try to go to Married Put Compare. And I've updated this even less. Okay. All right, I'm sorry. Let's just go back to where I was, July 12th. I'm sorry. This is for show, SHO. Let me just start with your first train of thought, and I'll just read it straight through. There's two comments come in. Let me do something really quick here. One original cost basis on June 3rd was $178.97. So I'm going to say that a while back, okay, I'm going to add an option leg. Yeah, that's what I need to do. I'm sorry. I'm going to say that, you know, back around when the stock went up to 200 from its 178 range, I was holding the 210 put, I think, but I'm going to say that I sold the July 220 call for $12 when the stock was moving up on or around the 20th, near expiration day. And see, my cost base is still $178.97, and I'm still holding the 210 put, and I'm going to say, you know what, oh, it went above 220 back a week ago, 2 weeks ago maybe, so I'm going to roll the leg. I'm going to pay not 26, but let's say we paid $19, no, let's say we paid $21 to buy this one back, and we've rolled up to the 240 call for August, and I collected $9. No, $6.50 because it was deep out of the money. But the date doesn't matter. I'm going to leave it as today, but just ignore that for now. Okay. So, and then of course I probably would have rolled the put up at some point. I'd probably be holding the 220 or the 230 put. Oh no, I'd be up at the 250 put right now. Let's just leave this as is. So Show says, I'm having difficult time tracking the positions in my portfolio view that I applied income methods on. Okay. After I apply income methods, the effective cost per share gets updated. Yes, it's taking into account the history of what we bought and closed. So this is showing the effective cost per share of the underlying This is a record of your original purchase price. This is letting you know that it has changed, generating income, rolling the puts, selling calls and having them expire, we hope, in that fashion. Okay. However, when I look at the original expected gain or loss, it's not there. I understand. So this original gain or loss on this position analysis view that Show's talking about, this is the return reflected against the original cost basis. And you say it's not relevant anymore because the gain or loss percentages are misleading. Why not show gains or losses in this fashion? Okay, it was actually a conscious decision. It was a conscious decision by our customers. A lot of customers who were doing other strategies, and even some doing the married puts, believe it or not, did not want this changed. They wanted this to stay the same. Investors who were selling covered calls thought it was an exaggeration that they're lowering their cost basis down more by more. They didn't want to see that. They wanted to see their original price. Although it's an extra step, Show, the best place to do when looking at a position, even if you've got 5, 10 positions, 12 positions open, is when you want to see where you are and what income methods are available. One by one, it's always best just to go to position actions and position analysis. I know it's an extra step, but this gives you exactly what you want. Shows you your current breakdown of your position based on that cost per share of 18797. The true risk, the future expiration if the stock stays the same, and all of your rollout opportunities that are available with the call, with the put to make it a better position. Okay. Now, all that being said, I've mentioned this, we've mentioned this to the programmers before. In the future, I can't tell you when, I don't know when the programmers might get a chance to look at it. In the future, you'll likely potentially have a means of toggling between saying look at analysis versus issue price versus effective cost per share. I can't give you any time frame when that would be available. Okay. But yeah, that's the key there. That's what's happening. That's why it's happening, is because for customers who asked for it when we made the change once, they wanted to keep this issue price, their original issue price, even though it's listed in the notes section for record keeping. They wanted to hold that, but see the effective cost per share. And you're right, you know, I after I've made some adjustments, I typically don't look over here. I always look at the profit and loss chart myself or the position analysis view. But I'll let Ernie and the programmers know that you had mentioned that, and that another customer would like to see a way to toggle between what was it based on original and what is it now based on my adjustments. Okay, let's see here. I've got a question from Will. Oh, and you did ask, Show, is there possible to add another 2 columns? Not right now, unfortunately. So not right now, but I'll get on it for you, and I'll remind them that's on the huge list. Okay. Question from Will. Is there any risk in setting up a short calendar spread? For example, by Tesla, August 9th. Tesla. Oh, pen went down. I'm jotting this down. Tesla, August 9th, 270 call, and sell a June 2020 270. Yes. In my opinion, you don't have to agree with me, Will. In my opinion, there is a problem with this, okay? Remember we talked earlier a little bit, and how we talked about how the options that are 6 months out in time, 8 months out in time, 343, what is that? I'm sorry, 11 months out in time are not 6 to 11 times the cost of the near term. When I'm buying, I want to buy further out to not only have the slower time decay on my speculation or insurance, but I have a lower cost per day. I have a lower annualized cost. And when I'm selling, I want to sell near term, you know, month by month or week by week, to increase my annualized premium, because the option that's 11 months out is not 11 times the cost if I did it every 30 days. Now, your structure, I'm sorry, August 9th, buying the August 9th 270 call. Selling the June 2020 270 call. Okay. All right, so right away, and this is just theory, right away we're going against two of the main caveats essentially of options trading. Number one is that when you're buying, we've already talked about it's better to buy further out. And when you're selling, it's better to sell closer in to get an increased annualized return. You're doing the opposite. You're buying close in, which means you'll have a higher annualized cost, and you're selling far out. Okay. Also, you'd say, oh, but this option here, I'm getting so much premium, and I'm getting it at a huge credit. This is true. Okay, let's just take a look. 540 versus 3770. I don't know why that keeps doing that. Hold on one second. And clear the drawings. I bet you that has something to do with it. There we go. Okay. This gives you a check mark profit and loss chart where you've got a credit here. $3,230. Max risk is only $17.37. That's the worst case here if the stock's trading right at 270. And the max profit's $27.55. Okay? And it really gives you sort of like a check mark view. This continues to go up in this direction and then sort of levels out, I believe, if I'm thinking correctly, the way it's structured. Okay, now, why do I have a problem with, oh, and you say, what did you say, risk? Just wondering since the risk-reward ratio is too good to be true. All right, here's something else you have to remember. Yeah, it's a 2-to-1. You're looking at this position. What is this profit and loss chart showing you, Will? And on anywhere you look, your broker, Robinhood, any service that you use to build a profit and loss chart for this position, what is this graph showing you? This graph is showing you the potential at August expiration. Okay? Only at August. It can't show you June because it has to read any controls such as this. It has to read what the long option would be worth at the near-term expiration to draw the graph. It can't go all the way out to June 2020. August, I should have looked first. August 9th is 28 days away. That's 30 days away. Okay? Now, you can say, well, I should be getting time decay, so even at August expiration, if it moves one direction or the other, I should see something. This maximum profit to maximum risk looks good, but where does the maximum profit occur? It's either all the way down here or all the way up here. Yes, you've got earnings coming up, and that might help you. But otherwise, you're sort of in no man's land here until it really drops down below 220, 230. Believe me, it's possible. It's possible with Tesla. I understand that. But this is only June. This is only in August. 28 days away. And you say, okay, well, if it doesn't do what I want, I can just buy to close this call, right? If the stock really falls, I can buy back this call cheaply. This call you sold, this 270 call, is all time premium, 37.70 of time premium. What did we show earlier? That with an option that's this far out in time, I'm not going to see rapid time decay in the first 30 days, 60 days, 90 days, 120 days. This is 343 days out in time. In the first 28 days here to August 9th, this call, even if it falls, is probably only going to lose $1 or $2 worth of time premium. It's still going to cost $35 to buy back. And this is gone. That's out. You've lost that $5.40. Okay? And this is still going to be $35, $36 to buy back. We saw that. Remember how the short option decayed so fast, and you're buying the short option, and the long option decays so slow. Yeah, I hit August 9th. I don't have a profit on this position unless the stock really falls and this really goes to zero. And you might be betting on that. I understand. But then what happens at August 9th? What do you got to do? Well, you're losing your protection here. Okay, that's going away. Let's say the stock's where it is 245. That's expiring. What do I have to do now? I've got to go out another 28 days to September 16th or so and buy another call for maybe another $5 or $6. This goes down to 28 of net credit. This option is still at 3,500. Still can't liquidate for a profit because I'm lowering this, and the time value of that far out option that I sold is not decaying fast enough because it's so far out in time. So what am I doing now? I keep having to buy calls so that I don't have a naked call, as we saw with the Tesla position earlier. I keep having to buy calls at $5 a clip every 28 days, and that would be 10 right cycles to get me to the 343 days out in time, which means what? I've paid $50 for insurance month by month because I wasn't seeing the time decay on this far out option when I only collected 37 in. And so now you've got a debit instead of a credit. This is harder to gauge with a normal movement stock because you're not going to get the decay that you want on that longer term option. You're losing more on the shorter term option, assuming the stock doesn't move or it stays out of the money. You know, where you only might see $1 or $2 of time decay here on your June 270, you're losing the whole 540, 550 on that near-term August option 20 days away if the stock stays right around 250, 260, anywhere below 270. You know, just stays in this range, you know, stays in here, you're not going to see much time decay on that far out option. That is the trickiness and the trouble with these type of what I call reverse calendars, selling something that's farther out in time and buying closer in. I'm increasing my annual cost for the hedge to remove the margin requirement of the naked call. I'm not getting the time decay that I want on the short-term option to counter the time value I'm losing on the long-term option, assuming the stock only moves on average, you know, 1 or 2% every 15 to 20 days. That's my concern with this strategy. That's why I am not a fan of it. Okay, so I want to show something else real quick to show. I'm going to go closer in, and not saying that this is a better trade. I just want to show a better graph. So let's say we did November 250 instead of the August 9th, and let's say we did the 250 in August as well. I just want to get a better graph of what this looks like for those who are not familiar with this reverse calendar. Selling the November farther out and buying the closer in August. Okay. Yeah, so it still didn't give me what I want. Maybe I should take a smaller stock. I'm going to take Trex. It's right around 72 today. So I can get a good graph view of this. I'll go December. Now let's keep October. I'm going to sell the 75 October, buy the August. That's what I wanted to see. Okay, so this is why there was a capped gain. It sort of just peters out here on this checkbox. Okay, that's check mark profit and loss chart, the reverse calendar. That's what we're looking at. But again, what do I know if the stock stays, if Trex stays right around $72, $73 in the next 30 days? Okay, or to August, let's just say to August expiration. Let's call it 73. And that'd be August 19th, folks. Am I right on that? Oh, August 16th. There we go. What do I get? The August call I bought lost 260. Right? I lose the entire 260 I paid for the August, and I've only seen, theoretically, 51 cents of time decay on the October 75. This is still at a loss. Right? It's going to cost me $384 to buy this back. I lose the full 260. My credit was only $175. That's what I don't like about this strategy, is it needs the movement one direction or the other in order to profit. You're not getting the time decay. And I know there are people out there who say, oh, well, you'll see that time decay work in your favor on that short options. You're going that far out on that sold option. Remember what we looked at already with the time decay curve. You're losing only 50 cents in this case, maybe $1 to $1.50 on the Tesla position in the first 30 days if the stock doesn't show a good movement one direction or the other. But you're losing $5 on the option that you bought because it's out of the money and all-time value, and it's in that 15-day decay period where it's quickly going to start going away. That's why I'm not really a fan of that strategy. Okay. All right. Well, ladies and gentlemen, we are at about 6 o'clock p.m. Eastern Time. I don't see any other questions that came in. I wish I could do a little bit better for JB as far as analyzing that call position. I couldn't find anything really good to use. So I do apologize for that. But I will say, if anyone has any last-minute questions, go ahead and send those in. But I do want to remind everyone that today's material are my thoughts on your questions, designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. I'm not suggesting getting into a married put on Tesla or XLNX, or doing a collar on XLNX or deep in the money covered call. Those were just the examples to show the risk and reward based on your questions. Options do involve risk. We can control them, as we saw today, with long collars and married puts, but the lie of leverage can get us in other strategies. We all know that. It may not be suitable for all investors. As Daryl asked earlier, remember, if you can go to PowerOp.com, just put in your name and email address. No credit card is required. And you'll have access to Power Options for 14 days, I believe right now, on the real-time service. Subscription levels after that start at $45 for the end-of-day data. The real-time service is $120 per month. Most popular, of course, is the delayed service, 20-minute delayed service without access to the historical. You can upgrade to the historical data at any time. It's only $35 more than the delayed service to get access to the historical databases. Other free stuff at any time. Remember, you can check out our blog, blog.powerop.com. You can go to the webinars page, powerop.com/webinars.asp. You can also find us on YouTube under User Power Options. Most of our Friday discussions and more are archived and posted on YouTube as well as on Power Options. If you do think of any questions, wow, that never does what I want it to. There you go. I'll just remind you, you can go to powerop.com, first name and last name and email address, and then you're all set there for the 14-day free trial. Okay. Good. It just paused again after I switched over. But here's a good one. If you think of any questions later on, ladies and gentlemen, send me an email anytime, support@powerop.com or support@radioactivetrading.com. You can also call us at market hours at 302-992-7971. Of course, as I reminded everyone, trial members and subscribers can schedule that free coaching session at any time. Free coaching sessions. It's not just limited to one. So Ernie, myself, and other staff are here to help you at any time. If you schedule a coaching session, more than likely you're going to get Ernie or myself. All right. Ladies and gentlemen, thank you again for joining me. Thank you for your excellent questions. Once again, JB, I apologize that I do not have a great and definitive answer on a potential repair or fix for the naked call on Tesla, but I'll keep looking and I'll ask for Ernie's thoughts as well. Have a fantastic weekend again. We'll see you all soon. Good night.